Hi, my name is Lawrence. I'm the author of Financial Freedom Through Property. One of the questions I get a lot from my students is it better to invest in a new build or in a property that's been already built many years ago? An example like a CBD kind of area. So in this short series, I'll be analyzing several new builds and just showing why investing in new builds can be risky and can be difficult. If you haven't already, please subscribe, click the notification button, join this tribe. I'll be sharing, as I always do, weekly updates and weekly videos, so make sure that you don't miss out on everything property related in the South African market. Welcome back to another episode of the series of the New Build Dilemma. Now, new builds is a very attractive way for people to get started in property investing because you're buying something that's shiny, that's new, that doesn't require any maintenance. And new build developers and marketing teams for these companies are very good at painting the picture of a new build being a very good, sound financial investment. In this series, we're going to unpack whether it's better to invest in a buy-to-let or into a new build. And the answer, quite simply, is it depends on your strategy, right? Both have pros and both have cons. If you look at your lower income sort of CBD market approach, you're buying properties for 2, 3, 400,000. You're renting for 6, 7, 8,000. You've got more than enough yield to be able to earn a cash flow, a profit at the end of the month. Right, so your income is higher than your expenses, leaving you with a positive cash flow on a month-to-month basis. That's what's great about that sort of lower income market. If you're looking at new builds, the strategy is not cash flow, the strategy is capital appreciation. From a cash flow perspective, 9 times out of 10, the income is going to be insufficient to cover the expenses, leaving you with a negative cash flow in the new build strategy. Right, at least for the first couple of years, let's call it 4 to 6 to 10 years maybe. Now, where the capital appreciation strategy lacks the cash flow, it is strong in the sense that there's a likelihood or a potential for the property to appreciate in value. If you look at your cash flow strategy, the appreciation is going to be minimal, if any. If you're going to see a 3 or 4% capital appreciation rate, that would be probably quite high. Versus your new builds have the potential to appreciate a lot more. Now, I use the word potential and speculation very carefully here because it is a gambling strategy. As much as a developer will tell you that the property is going to appreciate by 8 or 10%, or an estate agent might say that to try and convince you to make a buying decision, the reality is no one knows. And for me, that's why I've chosen the cash flow strategy and avoided the new build strategy, because I don't believe in that methodology. Right, the cash flow strategy, it's about income being greater than expenses. You can predict it, you can plan for it, you get that passive annuity income. The new build strategy works well if you're happy to lose money on a month-to-month basis, but you believe enough in the area that it will appreciate over time. So let's jump into a live example, and I'll take you through how I see a new build investment. Okay, we're looking here at buy-to-let.co.za, buy to let now. Now, this is a company called Central Developments. I just want to let you know that I have no affiliation with any of these development companies. I'm just looking at this as a purely investor perspective and sharing my opinion. So I mean no disrespect or have no ill intentions on any of the developers. I'm just going to speak my mind. So this is Central Developments, their buy to let now offerings. So first they say with up to returns of 17% on your investment. So I mean 17%, they're probably talking gross yield. They're not talking net yield, which is, that's pretty low. I mean, anything above 15% is decent and might be cash flow positive. But I'm a bit hesitant about that. So let's look at the first one here, the Junction at Forest Hill in Centurion from 695. So the first thing they're doing here is they're saying gross yields of 11.4%. So that's good to know. Anything below 15% means cash flow negative. Now remember in the slides I said that cash flow negative is just part of the package when it comes to new builds. If you're only looking for cash flow, you need to go to your buy-to-let strategy in CBD areas. If you want to participate in capital appreciation, then new builds make sense. Here they say cash flow positive investments. That probably means cash flow positive based on a cash offer. If you're going to get leverage from the bank, it won't be cash flow positive. And then they always often developers put 12 months free levies to try and incentivize you, to show you that it's cash flow positive. It might be cash flow positive in year 1. What about year 2, 3, 4 when I have to start paying those levies? So you have to be careful of these little marketing tricks that they use, and all development companies use them. Let's look at return on investment. Okay, here, so purchase price of 695, 6,500 rental. So your gross yield is 11%. It's below 15, so we know we can't expect it to be cash flow positive. Monthly levies and rates and taxes, net income, and then your return is 8.5. So yes, you're getting an 8.5% return on a full cash offer. So you have to have 695. There's no bond payments taken into account here. Now, a bond repayment on 100% loan to value on that is probably going to be more than your net income. So you're going to be walking away with, again, a negative cash flow. Now here they're projecting the capital appreciation at 5%, which then bumps up the return to 13.5, which is decent, assuming that 5% is achievable. I've bought in areas that I thought were going to appreciate massively. Fourways in Johannesburg North is an example, and I bought 10 years ago, and the property hasn't appreciated. And everybody told me, and every book I read and every article I read said that the appreciation was going to be 10% because of the booming area. It just wasn't. So it's an okay deal. I would say it's pretty average. Here they also putting a 9% management fee in place. So again, 9% kills all your profit. So classic example of a new build that will be cash flow negative, will take money out of your pocket on a month-to-month basis. But if you believe enough in the area, you believe in the ability that it will appreciate, then maybe it's worth taking the risk. Again, it goes back to your strategy. Now, for me, the strategy is always simple and always will be cash flow first. Capital appreciation, I don't buy into the speculation of it. But otherwise, Central Developments looks good. I'm sure they've got plenty of other deals, so look out for the next video. Please don't forget to subscribe, click like, post this, share this with friends, family. The more people that get to see this, the better. And thanks again for your support.